Welcome. I'm Catherine Magana here with Rachel Ivanovich, Vince Stefano, and Greg Carroll, where we're here to provide you insights about the markets, tax planning, and much more. Today is August 13th. I can't believe we're already in the middle of August. What happened? I think Vince, Greg, and myself have already gone on our summer vacation. Welcome back, Greg. He was just got back from Italy, and hopefully you had a nice time there.
He looks a little tired.
Right? He still had jet lag.
Jet lag's catching up, but it's all good.
Either that or the alcohol.
And poor Rachel still she's counting the days
Next
before
week.
she's taking us a little bit of time off. So it's
wait.
not, we do, it is important
The kids are already back to school, and I haven't taken my summer break yet.
They are.
What are you waiting for?
The cruise next week. The cruise.
The twins started their senior year of high school. Yesterday was their first day back at school. So I have one more year to go, and college is knocking at my door. But
Yes, it is.
all right, so let's talk about the markets. So there's mild inflation. The CPI numbers came in. We have strong earnings, which hopefully Vince will report on a little bit. The U.S. and Iran are fighting over who's in control of the Strait of Hormuz. So we're every day or every minute there's new news on that.
FIFA Cup's over.
Oh yeah, that's done, which is kind of nice. But looking at the consumer price index that came in, the report. So for July, it came in at 3.4%. And the core CPI, which is less food and energy, was at 0.2, so it came in at about 2.5%. So those are kind of some numbers that just came in recently. Looking at kind of with that information, it looks like the probability now of a rate hike has changed a little bit for next month. So at the next meeting, we're looking at potentially no change in the rates and about a 35% probability of a rate hike. So that's obviously has come down, or the probability of a rate hike has come down with this news. For the year, there's still the probability of having one rate hike between now and the end of the year. We're looking at 40 to 50% probability there. Mortgage rates are they haven't changed too much. We're looking at the 30-year at about 6.74 and the 15-year at 6.07. So that has come down. The 15-year came down slightly, but not too much. And then looking at 1 year, CDs are at 4.1, 1 year T-bills at 4.09, and then the 10-year at 4.63. So not too much change there. So there wasn't, if you even look at kind of where the markets are at over the last week, not a lot of change. The Dow Jones was down slightly, but the NASDAQ, S&P, and the Russell 2000 were pretty much flat over the last week. Year to date, the Dow Jones is at 11, as of yesterday, which was August 12th, the Dow Jones was at 11.87%. The NASDAQ was at 14.4%. The S&P 500 at 13.19, and the Russell 2000 at 22.71. But it was interesting. There wasn't too much movement that we saw over the last week or so. The week prior, yes, but not this last week. So with that, I know there's a lot going on with earnings and reports and
yeah, and I just want to. I'm going to start leading. I'm going to jump on your inflationary pressure just briefly. Everybody's been talking about inflation, and obviously we're seeing a lot of inflation due to the rise in oil prices, and people are wondering, well, what is the Fed going to do? Well, the problem is if the Fed raises interest rates, it has nothing to do with bringing more oil onto the market.
Right.
And so I think that what's going to have to happen is we're going to need to get some kind of breakthrough in the Iranian crisis, and that opening up the Strait of Hormuz with more oil flowing globally, that will bring down the price of oil. That will bring down inflationary pressures. And then I don't know what the Fed's going to do after that. And I will say one thing, the Fed, when you think about the midterms are about 80 plus days away. If they're not going to raise in September, I don't think they're going to raise in October, which is a couple, 3 weeks before the midterm election. So, we're probably looking out to December. Markets have been kind of quiet, like you say. Earnings came out, and I would say that for the most part, they were good. Most companies exceeded earnings across the board. And the majority of the mega cap tech stocks did quite well, but also the non-tech stocks did really well. They rallied off robust earnings, but they also rallied during the end of July because the momentum trade was moving away from technology and into more materials, industrials, energy, things like that. But when tech started rallying early August and now continuing, those stocks are still doing quite well. So we're still starting to see this market continuing to grind higher. And the big risks that some of the talking heads are now coming out with is you may see some kind of air pocket develop in the market. I'm not sure if that's going to happen, but you know how the talking heads are. One of the interesting things that's happening right now with the strong market rally, it's putting a lot of pressure on dividends. And companies are not spitting out as much dividends as they were previously. And that's because a lot of the free cash flow and profits are going to AI. They're going to the AI build-out. And what I found really interesting was that the current yield on the S&P 500 is 1.03%. Energy prices came down a little, and I now saw that there is $3 trillion of retail money sitting in money market funds. And they're yielding 3.49%, which is probably not a bad yield for a money market fund. However, if rates do start to subside, these money market funds will start to decline in yield. And if that causes a market rally, you will get that fear of missing out effect. So I think that a lot of this money market money may be used as we move into the latter part of this year and on into 2027. So,
Well, it's interesting you say that because I think a couple years ago when we saw the 5% money market rates, that people liked that. They're like, okay, I'll put some park it in money market. But now with the rates coming down and inflation and everything's kind of changed. So once again, you have to look at what am I getting, and then is it a taxable account? Do I have to pay taxes on that money? So are you really keeping up with inflation or not? And what's the purpose of that money you have set aside? And can you either generate income or growth with that money going
because
forward?
if inflation's at 2.8 or 2.9,
So
and you're getting 2.5, you're not getting a whole lot of profit over that. I mean, so
And you're paying taxes.
And you're paying taxes. So anyway, that's just my comments about where the market is, and I have a trivia question that I will ask my colleagues at the end. So.
Can't wait.
Suspense.
Nice.
Yeah, just little history here on midterm election years.
Oh,
and
gosh,
months.
elections are coming up, man. Here we go.
Like Vince said, 80 days away. Interesting breakdown here. They did statistics here. The trailing 12-month return up to November, so looking backwards 12 months, the average midterm election year is 7.3%.
For the S&P.
For the S&P, yeah.
And now we're at 13, you said?
And
The S&P was at 13, a little over 13.
Well, but you got to go back to November. And I think I looked at the numbers briefly earlier, and I want to say it was, in that ballpark still. But and during the month, the election month of November, the average return is 3% during November. Yeah, I mean that's it. And then it gets even better. The 12 months, 11 months looking forward. The average return, 17%.
No matter what party gets in.
11 months after the election, average return 17%. And when I look at this, going back to 1950, there's not a red year in there. They're all positive.
Wow.
Knock on wood.
Until
it just changed it this year. But
When you think about it, once the midterms are over, the uncertainty is taken out. The market can adjust now to whichever party comes in to control the House or the Senate. The market will start adjusting to how it's going to look at their policies and how they're going to
but
position
you look
their
at this
portfolios.
year, and it's probably going to be kind of stagnant, right? Because the Democrats probably do, gain some seats, and probably kind of neutralizes the current administration a little bit.
And the market likes that.
And I guess because they kind of have certainty, right? They know what to expect not much, kind of stalemate. So who knows? The worst year that I can see on there, I thought it was last in 22, but it was 4.3%. So kind of interesting. And also, I think we brought it up before, the election year that we're in, there's usually like a 17% pullback in the market. And we have not seen more than 5 or 6% pullbacks this year. So,
Well, I thought we saw a big pullback early in March, didn't we?
I think it was down about 9%.
About
yeah,
in
I don't
March,
think
and
it
then
got
it's
double
come back.
digits. Yeah.
Nothing double.
But,
yeah.
Yeah.
Anyway,
interesting. Well,
Yeah.
those
So it's not
figures-
all bad. It's
No,
pretty good.
no.
So
again,
you know what
long-term.
else happens after the election? Tax law
Taxes.
changes.
Oh, tax law changes.
Well, speaking of that, there is some news potentially. They're looking at the exclusion amount for real estate.
We will see
but
if
we'll
that
see. That's been on the
happens.
table for a
Oh, it's
long
been on-
time.
yes.
But
Oh, bumping up the 250?
Yeah, to 500 per spouse. We're hoping for that.
because
Let's do it.
there hasn't been an adjustment
need
in
to
years,
bring
right?
that up.
At least 20, 26, 27 years. But I wanted to
Million.
talk about if you're contributing to a 401k, or maybe you have children or grandchildren that are contributing to 401ks. And here's a question to ask them or yourself is, are you putting that money in pre-tax, Roth, or a combination of the two? And a lot of people don't know that you actually have that option, or that's out there for you, because these choices really can have different tax consequences. And so with the traditional pre-tax 401k, generally you get that tax benefit today. And your contribution reduces your taxable income, and the money grows tax deferred. But then later you have to take the money out and pay ordinary income tax in retirement. And that can bump up your required minimum distributions if you're putting it in pre-tax. With a Roth 401k, you flip that around, and so you pay the tax today, and your contribution doesn't reduce your current taxable income, but later qualified withdrawals are tax-free, which everybody loves tax-free. So the question is, which is better? Do you pay the tax today, or do you pay the tax tomorrow? Or, so the tax planning really will determine, so you need to be asking the question and actually doing the work. So if you're in your peak earning years, and or if you're married and your spouse has a salary, you really want to be looking at what your combined tax bracket is. And if you have investment income or rental income or other income sources, you need to be looking at everything to make sure, or maybe you're selling a property, so you'll be having proceeds that will be boosting your taxable income. So you really want to be looking at all the different factors. Oftentimes when you're younger, or maybe you're in between jobs, you'll have your income will be down for a year, so you'll want to shift that from pre-tax to Roth in 1 year to the next. So let's just talk a little bit about the 2026 contribution limits, because this is a really good time of year to be looking at your pay stubs, or maybe you're self-employed and you have a solo 401k, so you want to be looking to make sure that you're taking advantage of this. So for 2026, you can contribute up to $24,500 to a 401k, and if you're 50 or older, there's an additional $5,000 catch-up contribution, which brings your total employee contribution to $32,500. And then there's a special rule, of course, because in taxes there's always special rules.
Oh, wait, there's more.
Super catch-up.
So if you're turning 60, 61, 62, or 63 during 2026, your catch-up contribution is even larger. It's $11,250. So instead of the $8,000, it's $11,250. So that basically means you could potentially contribute up to $35,750 to your 401k this year. And that's not including employer match or anything like that. And then there's one more important change for 2026 that I wanted to mention is if you're 50 or older, your 2025 FICA wages from your employers that's sponsored that exceed $150,000, the 2026 catch-up has to be made as a Roth contribution. So why that's important is you may want to adjust your withholding, because all of a sudden you may have that additional amount of income on your tax return next spring. You don't want to be taken by surprise.
So it's interesting. We had a client last year. She was a newer client last year, and we ended up getting her pay stubs and looking at her 401k. And what we found was we originally thought she was doing pre-tax, but it turned out there was after-tax. She was doing after-tax, and she really needed it to be pre-tax. So by the time we reviewed that, she was able to make some adjustments. But then also for this year, it went for a full year of pre-tax, not after tax. For her particular situation, it needed to be not the Roth portion or the after tax, and so you kind of have to look at it kind of year by year, case by case, income, and like Rachel alluded to is. Are you selling a property, or is there something that's changed in your life, because that will dictate also if there's any changes. And the hard part is, you always hear do Roth, which is great because it comes out tax-free later. But the reality is you have to really look at, does it make sense or not? And
what tax bracket are you in today? What is your retirement income going to look like? And just don't automatically go pre-tax or say Roth. You really want to look at everything.
And one of the things that comes up is when we're reviewing some of the 401k plan statements for some clients and prospective clients, is a lot of times a lot of retirement plans, they automatically either put you in a money market fund or automatically put you in a target fund. And while that might be a good place to start, sometimes it's not your best for your overall plan and your risk tolerance. So it is important to have that looked at and reviewed, because I think sometimes what I find is some clients think they're having more growth potential, and they're really not, because they don't realize they need to make some changes. So that's why we do look at those outside investments when we're doing the planning, and happy to take a look at that for you if you have questions. But those are some things that come up periodically. So I think you have. What do you?
No. Fear and greed.
Oh, here we are.
Fear and greed.
Let's see. We are at.
I need to know where the fear and greed is.
So as of this morning, we were at 68, which is greed.
Oh,
so
I was going to say 68.
But we were at greed last week at 65, and the markets really hadn't moved too much over the last week. But we're definitely still in greed. And 2 weeks ago, at the end of July, we were in fear. So there's definitely been a big change over the last.
Fear and greed is about as volatile as the market sometimes.
It is. You look at it, you're like, wow, that jumps a lot. But it's kind of interesting how that happens as earnings come out. Stocks will appreciate off earnings reports, and we're in the very tail end now of the earnings. There's maybe one or two well-known names that will come out over the next couple 3 weeks, and
some of the earnings are overall it's amazing that we're still growing this fast.
And right now we've got a lot of secondary and tertiary companies reporting, but they're not market moving stocks. They'll move the individual stock one way or the other.
Doesn't NVIDIA do it this week? Are they still coming up?
No, not until a little later.
They're way later. Okay.
So we are, as they always say, in the dog days of summer. And my question to my colleagues at this table is, where did the term "dog days of summer" come from?
Must be an East Coast thing, right?
It's got to be. It's got to be a song.
I'm going to say.
Is it a song?
Louisiana.
Well, that's okay.
What are you shaking your head at?
That's a good guess. Actually, the term originated with the ancient Romans.
Oh,
really?
Because they saw the Sirius star, which is called the dog star, rise with the sun from the 1st of July to the end of August. And they thought that caused excess heat. And so they called it the dog days of summer.
Interesting.
Wow. Little trivia. You dug deep for that one.
I dug deep for that one. Well, it's been a slow period in the market. The dog days of summer.
All right.
All right. Well, we want to thank everybody for joining us today. I know we covered a lot of ground, and over the sessions, we do cover some tax planning, financial planning, and investments. If you have any questions about your own specific situation or to get clarity to see if this applies to you, that's what we're here for. Please, some of you have called us and contacted us, and we're happy to review your situation to see how this applies to you. So that's what we're here for, is to educate and help you learn and make sure that there's a lot of opportunities out there for you. So we want to hopefully you're enjoying the summer, and we'll see you next week.
Thank you.
Thanks.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.